In today's video, we're going to be doing a Q&A session. I've been asked a lot of questions over the last few months, so I thought it would be great to give you a property market update, share my thoughts around what's going on in Australia's property market and how you can make the most of building your own property portfolio. Now let's start off with a bit of a weird question, which you may have seen that something is a bit different here on the YouTube channel, and that may be my hairstyle. It's quite Nordic, got a little ponytail at the back. I've had lots of people comment on the YouTube channel or been wondering what's going on with his hair. I've actually got something that's called alopecia. It's an autoimmune disease that kills the hair follicles in your hair and essentially sends you bald. So I'm running this Peaky Blinders cross Icelandic Viking look for the next few months. So let's dive into the true question number one, which is what is the best way to find a good investment property? Now for me, it comes down to you need to understand your finances. I've got a property investment course called Invest with Purpose, which runs you through 3 hours of content about building a multi-million-dollar property portfolio. But at a high level, property investing is rather basic. You just need to understand what money you can borrow, and then based on that borrowing capacity, what suits you in terms of building a property portfolio. Now for Emily and I, it was about looking at the cash available. And when we bought our first home, we only had a $66,000 deposit. We used the First Home Super Saver scheme, which is a bit of a mouthful, but that allowed us to save some taxes and use those funds towards buying our first home. So look at strategies to get yourself into the property market faster. Look at using LMI, look at using first home grants or first home super saver schemes to get yourself a larger deposit sooner. You may not buy your dream home first, but maybe you can get your foot into the property market, pay less stamp duty, and then move back out into a rental property and rent your property out after 12 to 24 months. So for my money, a good investment property is one that meets your financial needs, so it's within your budget. And then number two, looking at your overall strategy and your micro level strategy for that next purchase. So for Emily and I, our first strategy was just to start, to get into the property market. So with that $66,000 deposit, we looked at our borrowing capacity, which was close to $850,000 at the time. And then we bought an $800,000 property, rented out some of the rooms to make our life a little bit easier and a little bit less stressful, and then reassess as we went to buy properties number 2 and 3. So a good investment property is the one that suits you, that's within your budget, and is the right property for the right price in the right location. This leads me into question number 2, which is how much do I need to invest in a property? So what's the minimum amount that I can use to buy an investment? For my money, I think you need at least $250,000 of borrowing capacity. So this probably breaks down to you need about $50,000 to get your foot into the property market. Now, if you can, it's obviously better to have a larger deposit, but for units and townhouses, it's about $250K to get started. And then if you're looking to buy a freestanding house here in Southeast Queensland, you'll need at least around a borrowing capacity of $500,000 plus. So looking at your numbers, look at the deposit available, have a chat with a broker or a bank, and then work out whether you can buy a townhouse, a unit, or whether you can actually go for freestanding houses, which is my preference, because land does the heavy lifting. So look for that property that has a good land value or good land component and that value add potential, and that's what I'd be picking for my money. Question number 3, which is how do I manage my taxes when building out a property portfolio? There's so many different taxes to think about. You've got stamp duty, you've got capital gains tax, you've got to think about depreciation, negative gearing, how does that work? So there's such a different way to do it. I've actually got a tax template and a video on that, which I'll link back to. But essentially what you need to do is you need to look at the income and the expenses in your property portfolio. Depreciation is one of those fantastic expenses because it's a non-cash deduction, which means you didn't outlay money to claim that deduction. So use depreciation to your advantage and get a surveyor to give you a depreciation report for your investment properties. When it comes to looking at your capital gains tax, for example, you need to time it because capital gains tax is paid out into the controlling entity. So if you and your wife own a property 50-50, then look at trying to sell that property in a year when you both have lower income tax levels. So say you both quit work for a year and you go on a holiday, maybe that's a good year to sell your investment property and realize the capital gain, but you'll pay less tax because capital gains is added into your marginal tax rate for the calculations. And if you hold an investment for over 12 months, you can generally claim a 50% deduction on the profit of that capital gain. Now, question number 4 is around structuring and financing. So how do I find the right loan structure for my investment property? Now, this is very detailed. This is very specific to an individual situation. But what I'll do is I'll share what I do with my investment properties. So for Emily and I, we like to structure it with interest-only loans on our investments, generally with a 100% offset account. So I have a background as a chartered accountant, and I used to work as an auditor many years ago and then a commercial accountant for a while. So given my background as an accountant, this is the way I see best value in structuring my property portfolio. So for my money, I want to put all of my cash into my offset account for my own home. So maximizing the cash that sits against my non-deductible debt. Then I want to have interest-only investment loans for my remaining investment properties. Again, I'd like them to have 100% offset accounts for flexibility, but generally I'm wanting to park all of my money into the offset account for my own home and then leave my other accounts with $0 in them for the offset for the interest-only investment loans. The reason I like to do interest-only is to boost my cash flow. It means I'm paying the minimum repayments for my investment debt and looking to funnel all of my money into the offset account for my non-deductible owner-occupied debt. So that's how I choose to structure my loans. You might want to do principal and interest. You might want to do interest only. You might want to do variable or fixed. For me, I generally stick variable, although we did fix a few of our loans for a 2-year period, which I'll be rolling off in January 2024. So take that into account. You need to look at your own situation and what's right for you. But for me, generally variable and generally interest only for investments. This next question is very easy. How do I manage my investment property? Pay a property manager to interview, vet, check the tenants, check the property, and pay them somewhere between 7 to 9% here in the Brisbane market. So very simple. Find the right property manager. If you don't know who to find, chat to your buyer's agent, look at local reviews. That's the best way to find a decent property manager. And don't be afraid to let them go if they're not doing a good job. So what are some of the risks when it comes to investing in a property portfolio? Some of the major risks that I see are people not forward planning. People tend to only have that 1 to 2 year horizon. And when it comes to investing in property, you should be taking a 5, 10, 15 year plus horizon. Property investment should be for the long term. Unless you're a developer or a speculator, you should be investing in property for that 5, 10, 15 year horizon. So that's one of the biggest issues that I see is that people make short-term decisions rather than mid to long-term decisions in their property investment journey. The other thing is people not understanding their cash flows. I run a lot of spreadsheets, some very basic, which you can download a free investment property calculator from our website at purposeproperty.com.au. And that basic investment calculator will let you run a cash flow on your investment purchase, looking at the income, looking at the expenses, and looking at your total debt. So it can be great to understand your numbers. Now, a lot of people don't understand their numbers and just hit and hope when it comes to the property market. So don't be one of those people that hit and hope. Make sure you understand the detailed numbers, understand that your risk is open to everything, both in the economy and in your own portfolio. Some of those macro economic factors that could impact your portfolio could be interest rates, could be wars and things like that. And then some micro factors could be your property specific. So land tax, it could be maintenance costs. So you've got to be aware of the macro and micro and how that might impact your investment. This leads me into the next question, which is timelines. So what is the best time to hold my property for? Every property is going to have a different strategy, but as I said before, you should be looking at around that 5, 10, 15 year plus time frame. So for Emily and I, we look to build out our property portfolio over, say, a 5-year accumulation period. And we did that. We built our $5 million property portfolio in under 5 years before the age of 27. Now, after doing that, we then look to consolidate a little bit, to do some more renovations, add some more value, refinance, restructure the financing side or the loan side of our debt. And then we look to strategize and go again. And that's how we're looking at a motel purchase, potentially in 2024, 2025, or 2026. So I am looking to sell my property. This is question number 8. So what do I do if I'm looking to sell? Now, I actually think you can sell your property yourself. We've done that for several of our properties. I sold my mother's home. We sold our flip project. We've sold our pastor's property. I think it's actually not too difficult to sell your own home and hold an open home and have the contract drafted by your lawyers. But if you must get a sales agent because you think that they're going to do a better job, then sure, go for it. Spend that $20,000. But for about $1,000, you can get your property up on domain and realestate.com.au through a platform called Property Now. So if you are going to pay that agent 20 grand or 15 grand, then just make sure you vet them based on their reviews and based on their quality of service. You want to find someone that meets your needs, that's looking and understanding your situation. So find that sales agent that you connect with that is going to do a good job and has some good reviews. And if you're going to sell yourself, have a crack. Essentially, get the photos together, put it up online, hold a few open homes and see what happens. You can always hand it over to a sales agent down the track. Lots of people don't hesitate to sell with a sales agent, but some people hesitate to use a buyer's agent. I think if an agent, a buyer's agent or a seller's agent presents their value and is value to you, then go ahead and use them. Otherwise, have a crack yourself. What are some of the major mistakes I see that property investors make throughout their journey? Oh, wow. I mean, mistakes happen. It's part of life. But I think the biggest one is in this day and age, people are over-researching, not taking action. Okay, some people do under-research and don't understand enough of what they're getting into when it comes to property investing. But I think most people watch my videos, watch a lot of other YouTubers out there, consume a lot of podcasts, read a lot of books these days, and are covered with information overload. So in my opinion, you need to see clearly as to what you're looking to achieve, both in the short and the long term. So put that down on paper. Take out a pen, take out a notepad and jot down exactly what you want to do over the next 12 months, over the next 5 years, over the next 10 years, specifically for property investment. And that'll help give you clarity on what to do next. Another common thing we see is people overpaying because they haven't done their research or comparable market analysis. All this means is understanding the property market in detail. Because we're local area experts here in Southeast Queensland, we have a very good handle and very good relationships with a lot of selling agents, and we understand the property market intimately here in that 35-kilometre ring around Brisbane CBD. So you need to know the area you're buying in. So do specific research if you're looking in a suburb, cluster of suburbs, or a government area for that matter if you're looking to narrow in on a location. This will help you not overpay. If you understand what market value looks like for any given property, you'll be able to work out where your max price sits and you'll be able to make competitive offers. If you're continually missing out and you've been looking for 6 to 12 months, maybe you're looking and throwing out too many low balls. If you jumped at a property and you bought it within your first 2 weeks, maybe you overpaid and got a bit overzealous. The other thing we tend to see is people plod along for 6 months and then pay way too much at the end because they get sick of it. And then a lot of those people come and use our buyer's agency services because they're worried about overpaying or buying a lemon. So make sure you do your due diligence, look at the comparables, do your flood checks, chat with your lawyers, and make sure you're doing the right level of due diligence for your property purchase. This leads me into that next point, which is avoiding buying a lemon. That's a mistake a lot of investors do make. Now, one of the ways you can avoid buying a lemon is to use a building and pest inspector. If you can find an inspector to look over the property, you're getting both the land and the asset on that land. So make sure you do your checks as well with your lawyers. You can get a lot of free information on developer hubs for each of the local councils. So put together the information from your building and pest inspector, from the developer hub, from your lawyers, and bring that information together to make an informed decision. The last big mistake a lot of people make is getting their finances wrong. They buy the wrong property at the wrong time, overpay, or they don't structure themselves in a way that allows them to build a property portfolio. To build a property portfolio, you need equity or cash, and you also need serviceability. So there's two pieces to the pie, the capital and the cash flow. You need to find the balance between being asset rich and cash poor, or having lots of serviceability but no capital to actually allow you to build the property portfolio. For me, it's a continual balance between the capital and the cash flow. For Emily and I, early on, we didn't have any capital, but we had cash flow coming in from our day jobs and we were continuing to save. So that was the start of us building our property portfolio. And that's why when I build out property portfolios for myself and for clients, generally we'll focus on capital growth first. It is very dependent on your situation. But as a general rule of thumb, focusing on capital growth first allows you to build your capital, and then you can refinance that capital to build your cash flow over time. If you're not working a job, you won't get access to the serviceability. So that is one of the biggest mistakes I see, is that people don't find the balance between building their capital and then building their cash flow. So some people go cash flow, cash flow, cash flow, and then get stuck because they don't have the capital to keep going. And some people go very blue chip, very capital heavy, but then don't have lifestyle or choices off the back of those big assets. So you need to find the balance between the two that suits your property portfolio. This leads me into point number 10. How do I take action? If you are struggling and you want to build your investment property knowledge, I have a course called Invest with Purpose. For less than $500, it's like sitting down with me for over 3 hours. You get access to an Excel spreadsheet, and it will walk you through building a multi-million-dollar property portfolio. Now, for the next 15 people, we're going to be offering 15% off the course, because I believe in offering an affordable course. When Emily and I first released this, it was several $1,000s. But after sitting down and having a chat and wanting to make the course more affordable for people to learn about property investment and exactly how we built our multi-million-dollar property portfolio, we knocked the price down to under $500. So if you use the code 15OFF, 15OFF, then you'll get 15% off the course for the next 15 people. If you're also interested in sitting down and having a chat with myself, going through your strategy, and you're looking to buy a property here in the Greater Brisbane market, then head over to purposeproperty.com.au to book in a free strategy session with myself. We'll sit down, have a chat about your situation, talk about your short and your long-term goals, and how we can help you secure your own home or an investment property here in the Southeast Queensland market. I hope you got great value out of this FAQ session, so thanks for sticking around to the end. I'll see you in the next one. Peace.